If you have shares in your portfolio, you need to know about dividends, corporate events, and corporate announcements. What are the topics we're going to look at? We're going to look at dividends, a share trading cum dividend or ex-dividend, dividend ex-date, record date and payment date, dividend withholding tax, double taxation treaty, corporate actions, and corporate announcements. Why do some companies pay dividends? A number of different reasons. To provide shareholders regular income, pension funds and retired people like to receive income from investments in shares to meet ongoing expenses. The companies may want to tell the market that the company is financially stable and is generating profits. If a company is earning more cash than it needs to reinvest into the business, they give it back to the shareholders as dividend. In some countries, dividend income may be taxed at a lower rate than capital gains, so dividends become more tax efficient for shareholders. And sometimes, the company simply doesn't know what else to do with its cash, can't reinvest it profitably, and does not want to buy back its own shares, which would be expected to increase the share price and deliver higher capital gains to shareholders. So they pay the dividend. Why do some companies not pay dividends? Many young companies prefer to reinvest their profits to grow the company. Companies like cash reserves to repay debt, pay bills, manage fluctuations in profits, hire additional staff, and be ready to invest when opportunities come up. Some investors prefer to take profits as capital gains, that is, profit from the sale of the shares, instead of receiving dividends. This may be because capital gains is taxed at a lower rate in their country. Some companies therefore use their profits to repurchase their shares in the market, helping push the stock prices higher and increase the potential profits for their investors. Please find out the tax you would pay in your country on dividend income and profit made from selling shares, which is called capital gains. There are two categories of dividends. There are interim dividends, which are paid during the accounting year as decided by the board of directors and without shareholder approval. Interim dividends can be paid every 3 or 6 months. And then there's the final dividend. These are paid following the end of the accounting year with the recommendation of the board of directors and with full shareholder approval. So what are these different types of dividends? A cash dividend is the most common form of dividend. It's just paid in cash from the net income of the company. A share dividend, that's also called a scrip dividend, is when a company pays a fractional number of its own shares for every share held by the shareholders. A scrip dividend can save the company cash, but requires it to issue new shares, which could reduce the share price by increasing the total number of shares outstanding. A property dividend is a dividend that's paid in the form of an asset other than cash or the shares of the company. It could, for example, consist of the shares of another company that the company is invested in. A special dividend is usually a one-off payment due to an unexpected profit or the sale of an asset or business that the company used to own. There are two important definitions you need to be aware of. If a share is called as trading cum div, it means that if you buy the shares, you would be entitled to receive the next dividend that the shares are going to pay. But if a share is trading ex div, it means that if you buy the shares, you would not be entitled to receive the next dividend. There's a date on which the shares switch from trading cum div to ex div. That's called the ex div date. When a company decides to pay dividends, there's a declaration date on which the board of directors declares the next dividend, its date and its amount. The ex-date is a date on which the shares start trading without entitlement to the immediately following dividend. To receive the dividend, the buyer would need to buy the shares before the ex-date. The record date is the date on which the list of shareholders is used to determine who is entitled to the next dividend and who is not. The record date is usually set so that the buyer of shares on the last business day before the X date would be registered in the company's records on time to receive the dividend. In many countries, this happens within one business day, but in some countries like Japan, China, South Korea, and Hong Kong, this may take 2 business days. Then there's the payment date, and this is the date on which the dividend is actually paid to the account of the shareholders on record. The payment date can be a few days after the X date or even a few months after that. One cannot talk about dividends on shares without saying a word about dividend withholding tax. A dividend withholding tax, or WHT, is a tax deducted from the dividend payments to shareholders. It is collected by the company that's paying the dividend and paid to the tax authority. Foreign shareholders are usually subject to higher withholding tax rate than local residents. In some countries, the local residents pay 0 withholding tax. Dividend withholding tax is usually a certain percentage of the dividend amount. The percentage depends on the country of residence of the shareholder and whether there's a double taxation treaty, or DTT, between the country of the company paying the dividend and the country where the shareholder is resident. The amount of tax withheld can sometimes be reclaimed in part or fully by the shareholder in another country as a tax credit or refund. This usually happens when there's a double tax treaty. However, there are also double tax treaties that do not cover dividend withholding tax. We've talked about double tax treaties. What are they? A double taxation treaty is an agreement between 2 countries on taxes and other payments that investors from one country are subject to in another country. These agreements may cover many different topics for individuals and companies, ranging from interest to dividends, capital gains, and royalties. Let's look at an example of how a double taxation treaty works. A German resident owns US shares that pay a dividend of $100. Normally, a 30% withholding tax would be applied in the US. However, Germany has a double taxation treaty with the US which reduces the withholding tax on dividends to 15%. The German investor will therefore receive $85 instead of $100. The German investor can apply for a foreign tax credit of $15 in Germany to avoid double taxation. He will be taxed on the $100 but will be assumed to have already paid $15 in taxes. If the German investor has been charged more than the 15% treaty rate, a refund can be requested from the US tax authorities. From time to time, shares in your portfolio will become subject to a corporate action. So what are these corporate actions? First of all, let's look at the list and then we define them one by one. Common corporate actions include stock splits or share consolidation, which is also called reverse stock split, rights issue, share buyback, mergers and acquisitions, M&A, takeover, spin-off, tender offer, and bankruptcy or liquidation. Let's go through the list of corporate actions one by one. Stock split. This is when a company issues additional free shares to shareholders to lower the share price. This can increase the liquidity of the shares as each share becomes more affordable. The value of the company does not change, but the price per share reduces as there are then more shares. The theoretical new share price is calculated by dividing the market cap of the company by the new number of shares. In August 22, Tesla did a 3-for-1 stock split. Shareholders received 3 extra free shares for every share they had. As a result, the share price reduced to nearly a quarter of its previous value because each share ended up becoming 4 new shares. Second corporate action we're going to talk about is share consolidation. This is the reverse of a stock split. The company replaces several existing shares with just one new one. This increases the price per share as the number of outstanding shares reduces. In June 2024, Fincantieri SPA, an Italian shipbuilding company, executed a 1-for-10 share consolidation. This reduced the number of its shares outstanding from 1.7 billion to just 170 million and increased the stock price by almost 10 times. The value of the company was not affected. The third corporate action we will look at is a rights issue. When a company needs to raise capital but cannot borrow the money easily from banks because its financials are not in great shape, it can offer new shares to existing shareholders at a discounted price. Shareholders have the right but not the obligation to buy the new shares. Discounts offered can be substantial. If a shareholder does not exercise their rights, the rights can be sold and the proceeds paid to the shareholder in cash. The rights have a value because they entitle the holder to buy the shares at a price below the market price. As an example, in May 2024, Alstom, the French transportation company that designs and manufactures high-speed TGV trains, launched a rights issue with a subscription price of €13 per share, which was a discount of around 28% to the previous share price. As the shares offered in a rights issue are usually new shares, they increase the number of shares outstanding, so the price per share reduces. There is an expected share price after the rights issue, which is called the theoretical ex-rights share price, or TERP. This is calculated by taking the market cap before rights issue, adding to it the cash raised in the rights issue, and dividing the whole amount by the total of the new shares and the existing shares. Next, we look at share buybacks. In most countries, companies are allowed to buy back their own shares. In some countries, shares which are bought back must be cancelled, and in other countries, they can be kept as treasury shares and reissued later. Treasury shares are not entitled to dividends. Share buybacks are often used to return value to shareholders as buying shares increases the share price. This may be more tax efficient than just paying the shareholders a cash dividend. Share buybacks also increase the EPS, that's earnings per share, by reducing the number of outstanding shares. When the number of shares goes down, earnings divided by the number of shares, that ratio goes up. All intended share buybacks need to be proposed by the board and authorized by the shareholders at the AGM. Buybacks are usually authorized for 1 year. There are a few other corporate actions that you need to know about. Mergers and acquisitions, or M&A. This is when a company merges with or is acquired by another company. Shareholders receive cash or the shares of the resulting company. Takeover. Another company gains control by purchasing the majority of the shares of the target company. In a takeover, the shareholders of the target company receive cash or shares of the company that takes it over. Spin-off. This is when a company separates a particular division or unit to create a new company. It usually offers cash or shares in the new entity, if it becomes listed, to the existing shareholders. Tender offer. This is a public offer by the company itself or by another company to buy the shares from existing shareholders. Tender offers are usually launched at a price above the current share price. Sometimes, when very large shareholders wish to sell their shares in the company launches a tender offer to buy the shares. However, for legal reasons, it needs to make the same offer available to all shareholders. Bankruptcy or liquidation. A company liquidates its assets and distributes the proceeds amongst its creditors and shareholders. With some corporate actions, the shareholders need to make a choice. Shareholders can often choose to receive a scrip dividend instead of a cash dividend. So they choose to receive some shares or just cash. In tender offers, shareholders have to decide if they wish to accept the offer price. In a rights issue, shareholders need to decide if they wish to exercise the rights and buy the shares at the offered rights price. In most other corporate actions, shareholders have a largely passive role unless they group together to challenge the proposed corporate action. Now we say a word about corporate announcements. All listed companies are required by securities law to periodically publish their financial statements. In practice, companies also provide guidance for the following few months or a year. The information in corporate announcements helps shareholders and analysts to review a company's progress and estimate its future prospects. Companies may include many kinds of information in their announcements. The timing and frequency of corporate announcements depends on the securities law of each country, and some aspects can be selected by the companies. Large companies usually make announcements every quarter. Using the data in corporate announcements, analysts produce share price, revenue, EPS, and profitability estimates. If the announced company results are below or above the average of previous analysts' forecasts, the share price of the company could go down or up. Someone famous lived in this house on the island of Elba. Any idea who it was?